Investing for the long run. 8 tips to get the best long-term returns. The magic of compounding just adds to the value of a sound and successful long-term investment decision. Compound interest is earning interest on interest. Over time, your long-term investments will earn more and more money from the effects of compound interest. Compound interest is what makes investing a worthwhile pursuit. So how do you invest for the long run and get the best returns on your investment? In this episode, we'll walk you through some simple rules to help you navigate the market and get the best long-term returns. But before we dive deeper, let's quickly take a look at how to make wise long-term investment decisions. The difference between a good investor and one who makes bad investment decisions is the mindset. Having the right mindset allows you to make favorable decisions concerning your investment. More often than not, we tend to believe what we feel and think have little or no effect on our investments, whereas that is totally untrue. Although we can't control the market, our mindset has a huge influence on how we react to whatever happens with the market or our portfolio. As an investor, the greatest enemy to your investment is fear. You lose a sense of good judgment when fear or panic gets in the mix. Fear could make you get low returns on investments, especially during market crashes. That said, being overconfident in your abilities can also be really dangerous. Don't ignore the stats and take huge risks in the hopes that your investing skills will save you. Make sure you always check your growing confidence and always have a healthy skepticism as a genius investor. Now you know what it takes to make wise long-term investment decisions. Let's go straight to share the 8 powerful tips to get the best long-term returns on your investment. 1. Stick to your investing strategies. Your investment strategy is like your game plan to building your portfolio. But it is very important that you find the one that's right for your objectives and situation in life. A 25-year-old should have a different strategy than a 65-year-old. We generally spend a decent amount of time planning for our workday, a vacation, and buying a car, but we often forget or choose to ignore the most important plan of all, mapping out our investment strategy and plan for growing old and retiring. Investing your money without an investment strategy is like a football team going into a game without a playbook. Although they're not required, they significantly improve your chances of winning. Let's take a look at some common investing strategies for you to choose from. Common investing strategies. Value investing. An investment strategy made popular by Warren Buffett, the principle behind value investing is simple. Buy stocks that are cheaper than they should be. Finding stocks that are underpriced takes a lot of research on the fundamentals of the underlying companies, and once you've found them, it may take a few months or years for their price to rise. This buy and hold technique requires a patient investor who wants to keep their money invested for a few years. Income investing. A great way to build wealth over time, income investing involves buying securities that generally pay out returns on a steady schedule. Bonds are the best-known type of fixed income security, but the category also includes dividend-paying stocks, exchange-traded funds, ETFs, mutual funds, and real estate investment trusts, REITs. Growth investing. This is an investment strategy that focuses on capital appreciation. Growth investors look for companies that exhibit signs of above-average growth through revenues and profits, even if their share price appears expensive in terms of metrics such as price to earnings or price to book ratios. Small cap investing. This is an investment strategy that fits for those looking to take on a little more risk in their portfolio. As the name suggests, small cap investing involves purchasing stock of small companies with smaller market capitalization, usually between $300 million and $2 billion. Socially responsible investing, SRI. A portfolio built of environmentally and socially friendly companies while staying competitive alongside other kinds of securities in a typical market environment. In today's modern world, investors and the general public expect companies to maintain some social conscience, and they're putting their money where their mouth is. SRI is one path to seeking returns that poses a significant collateral benefit for everyone. 2. Diversify your portfolio. Spread your risk by investing in a number of stocks in different markets and in mutual funds, bonds, and other instruments. A good rule is that no other stock or other investment should be more than 10% of your total portfolio. Invest in different geographic areas such as the US, Europe, Asia, and emerging markets. Diversifying into property funds, commodity funds, and hedge funds, this should give you protection against a collapse in any one particular sector. If you're still unsure how to diversify your portfolio, make sure you hit that subscribe button and stay tuned for our future episode covering that topic in detail. 3. Do your research. Take advice from various sources. Invest in some companies whose products and strategies you like. There are a multitude of comparison sites and other resources on the internet to help you to analyze and understand investments. Past performance is no guarantee of future performance, but we would generally prefer to choose a mutual fund or unit trust that has been a strong performer over the last 2 years and which offers low management fees. 4. Run the stars and sell the dogs. Monitor your investments and compare their performances against the market index. If some of your holdings do well, then the temptation is to cash in and take a profit. It seems natural, but if you're in this game for the long term, then you want investments that grow over the long term, so when you find winners, cherish and retain them. On the other hand, you should ditch the dogs that significantly underperform the market. The temptation to hold on to them in the hope of a rebound, or worse still, to increase your holding at the lower price. This is generally a poor strategy, and it's safer to take a small early loss rather than a large one later on. Do not cling on to stocks for emotional reasons. Sell the dogs and run with the stars. 5. Reinvest dividends. A surprisingly large part of the overall growth in most portfolios come from reinvested dividends rather than in appreciation of the stock prices. A yield of 3% may appear small, but over a period it makes a big difference. Choose some investments with a solid history of dividends and use them as the ballast in your ship. 6. Be contrarian. This advice is much easier to give than to observe. When the stock market is low, buy stocks. When the stock market is high, sell your worst performing stocks and buy other investments such as property or bonds. 7. Take the long view. You're in this for the long term, so do not make frequent trades. The commission will eat into your funds. Do not follow fads and fashions. Diversify in a sensible way. Do not panic when markets occasionally crash. These are buying opportunities for the brave. 8. Consider investing with Robo-Advisors. With Robo-Advisors, all you need to do is deposit money and the rest happens automatically. The Robo-Advisor will make your investments for you, generally across a long list of ETFs, index funds, and bond funds. Here is a list of the best 5 Robo-Advisors to consider. Betterment. Betterment sets the standard for service. It offers automatic rebalancing, tax loss harvesting, a personalized retirement plan, as well as the opportunity to buy fractional shares in funds so that all your money is invested rather than having to wait until you have enough funds to buy a full share. Wealthfront. One of the largest robo-advisors, Wealthfront offers goal-based investing that helps you understand how your financial choices today affect your future. Wealthfront also provides tax loss harvesting, and the fees on its ETFs are among the lowest in the industry. Plus, the firm provides interest on its FDIC-insured cash management account and doesn't charge management fees for it either. Ellevest. While Ellevest focuses on women specifically, its financial planning incorporates the needs of everyone. Ellevest is great for goal-based investing, even if you have multiple goals. Unlike other robo-advisors, Ellevest charges a monthly fee ranging from $1 to $9, depending on what you need. The basic tier gets you an investment portfolio, access to education, and some banking features. SoFi Automated Investing. SoFi has expanded into the realm of robo-advisors with an incredibly investor-friendly service. The company provides automatic rebalancing and goal-based planning to help you reach your life objectives. Plus, you'll get career services, access to financial advisors, and discounts on other SoFi products for no extra cost. Charles Schwab Intelligent Portfolios. With Intelligent Portfolios, Charles Schwab is going after the robo-advisor market hard. Well known for its investor-friendly practices, Schwab brings this same spirit to robos, with no-cost features such as rebalancing, automatic tax loss harvesting, and 24/7 access to US-based customer service. Finally, be prepared to sell when you eventually need the money. You invested it to build financial security for you and your family, so it's better to use it when needed rather than to scrimp along in order to become the richest man in the cemetery. That's it for this episode. Please give us your feedback in the comment section below. To watch more episodes on financial topics like this, hit that like and subscribe button. If you want to support us even more, buy us a coffee from the link in the description. Good luck and see you in the next episode.